My client Sarah had $200,000 in the savings and felt financially secured. 6 months later, she lost her job, her husband got sick, and their emergency funds was gone in 90 days. She made the same 4 mistakes that destroys families' wealth every single day. But here is the thing. Wealthy families often avoid these mistakes. They follow a completely different playbook that protects them when disaster strikes. By the end of this video, I'm going to review the 4 critical warning signs that always appear before financial collapse and show you the exact strategy wealthy families use to stay protected. Hello everyone, I'm Sheyi Bakari and I help families with their money here in Ontario, Canada. I saw firsthand how missing these signs cost Sarah's family their security. I've seen too many good people lose everything because they don't know these signs. The wealthy families I've worked with have a strategy to reduce risk when tough times hit. Let me show you what families who seem secured on papers are actually missing. These warning signs appear in the same pattern every time. In 2008, the Johnson's family looked perfect on paper. They had $400,000, a house, 2 cars, and $50,000 in their RRSP. The husband, Mike, worked at a big company for 15 years. Lisa, the wife, is a stay-at-home mom with their 2 kids. They felt safe and secure. Then in the month of September, Mike's company started laying people off. The subprime mortgage crisis sent market crashing. Their RRSP lost half of its value in 3 months. By Christmas, they were selling their house to avoid losing it to the bank. These stories happen over and over again. Financial collapse follows the same patterns every time. The wealthy families I have worked with knows these patterns. They avoid them completely. These warning signs shows up before the 1929 crash, the 2000 dot-com bubble, and the 2008 crisis. These same signs appear in personal finances right before families lose everything. Warning signs number 1 is called overleveraging. This means borrowing too much money against your house, cars, and credit cards without backup plan. In Canada, household debt levels climbed to record high. This means families owe far more than they can safely handle. Before the 1929 crash, investors borrowed heavily to buy stocks. When prices fell, they lost everything. Families do the same thing today with mortgages and credit cards. Warning sign number 2 is lack of diversification. This means putting all your money in one place, just like tech investors in the year 2000 who lost everything when the dot-com bubble burst. Families who stacked their RRSP into one fund face similar risk. Many Canadian families put everything into RRSPs or companies' pensions. Mind you, your RRSP can do the same thing if the market crashes. And warning signs number 3 is insurance gaps. This means having no protection when the main income earner gets sick or dies. Many families lack adequate life insurance and disability coverage. They can't cover their bills if something happens to the person who earns the money. This brings us to warning signs number 4. I call it no emergency liquidity. This means your money is tied up where you can't get it quickly. Many people have credit card debt than emergency savings. When emergencies hit, these families have no cash to handle them. These warning signs create a house of cards. When the unexpected event happens, the whole thing falls down. The COVID-19 pandemic shows this clearly. Families with these warning signs lost everything, but some families stayed completely protected. They knew something most people never learn. The wealthy families I've worked with have a completely different financial playbook. Most people never learn these strategies. The wealthy don't put all their money in RRSP or mutual funds. They use whole life insurance as their financial foundation. This isn't just about death benefit. It's about creating a guaranteed cash value that grows every year no matter what happens in the market. Here is how whole life insurance works. You pay your premium to the insurance company. Part of your money goes to death benefit, the rest goes into the cash value account. This cash value grows every year with guaranteed minimum interest rates. It doesn't matter if the stock market crashes or the companies fall apart. Your cash value keeps growing. This approach is called the infinite banking, a concept detailed in Nelson Nash's book, Becoming Your Own Banker. This is how it's done. You use your own life insurance as your own personal bank. Instead of borrowing money from the banks, you borrow money against your cash value. The insurance company charges you interest, often between 5% and 8%, but you pay it back to yourself. You become your own banker that way. During the 2008 crisis, dividend-paying whole life insurance policies kept paying dividends. Companies like Sun Life, Manulife, and Canada Life continued their dividend payments while stock market crashed. The cash values in these policies grew steadily. Families with these policies had money available when others had nothing. These systems create multiple income streams through annual dividend that you can take as cash, use to buy more insurance, or let grow inside your policy. This gives you options that stocks and bonds can't match. This system protects against all four warning signs at once. You can't over-leverage because you are using your own money. You have diversification because your cash value grows outside the stock market. You also have life insurance protection built in. You have emergency liquidity because you can access your cash value quickly. The wealthy use this to build personal banking systems. They never worry about banks' approvals or credit scores. They have their own money ready for opportunities. When real estate crashes, they buy properties. When business struggles, they invest in them. This makes them recession-proof. This whole life insurance system isn't just insurance, it's a complete financial foundation. But how exactly does someone build this system from scratch? Nelson Nash shared how he rescued his business using his policy cash value when interest rates hit 21% in the 1980s. He was facing bankruptcy when he discovered he could use his whole life insurance policy as his own personal bank. This became the foundation of infinite banking today. As I've explained, you buy a dividend-paying whole life insurance policy and pay more than the minimum premium to build cash value faster. When you need money, you borrow against your cash value. The insurance company gives you a loan using your policy as collateral. You pay interest on this loan, but here is the key part. You pay it back to yourself. This creates a private banking system that remains accessible even during economic downturns. Your cash value keeps growing even if you have a loan against it. The policy may still earn dividends, though this depends on the insurance company's performance. Your money grows tax-free while you still have access to it. Banks can't take this away from you. Market crashes don't matter. The wealthy families use this system to fund everything. They pay for their emergencies without touching their investments. They fund business opportunities when banks won't lend out money. They buy cars and pay themselves back instead of paying car loans. They fund their children's education. They buy real estate during market crashes. Remember, the interest you pay goes back to yourself, not the bank. The insurance company uses your interest payments to pay dividends to all policyholders. So, since you are a policyholder, you get some of that money back. This creates a closed loop where you benefit from your own interest payment. These systems provide life insurance protection while also building wealth. Your families get the death benefit if something happened to you. You also get to access the cash while you are alive. This money typically passes to your children tax-free upon your death and may avoid probate if structured properly. Infinite banking eliminates dependency on traditional banks. You don't need their approval process. You don't worry about credit scores. You have your own money ready for opportunities. This strategy creates generational wealth that protects your families forever. But how do you know if you need this protection? Most people don't realize they are already showing the warning signs. Let me show you how to check your own financial situation for these warning signs. I want you to grab a calculator and some paper. We are going to do this together right now. First, let's calculate your debt to income ratio. Add up all your monthly debt payments. These include your mortgage, car loans, credit cards, and any other loans. Now, divide that number by your gross monthly income. Whatever you get is your debt to income ratio. If what you get is higher than 35% of your income, too much of your income is going to debt payments. Next, let's check if your investments are not too concentrated. Look at where you keep your money. Do you have everything in your RRSP, company's pension, or one mutual fund? Try to limit any single asset to under half of your portfolio. This creates the same risk that destroys tech investors in the year 2000. Now, let's identify your insurance gaps. Compare your monthly income replacement needs against current coverage. Add up your monthly expenses, debt, family needs, and ask yourself how long would your current savings last? Most families discover they have huge gaps in protection. They can't cover their bills if the main earner gets sick or dies. Here is how to measure your emergency liquidity. Count how much cash you can access in few days without penalties. This includes savings accounts and available credit. Don't count RRSP or locked-in investments. Financial advisors recommend 3 to 6 months of expenses in liquid savings. Most families have less than 1 month available. So now, if you found these warning signs, here are your action steps. Start by creating a budget to track where your money goes. Build an emergency fund. It doesn't matter if you start with $50 per month. Review your insurance coverage to find the gaps. Consider whole life insurance as your foundation. To find qualified advisor who understands infinite banking, look for someone with experience in dividend-paying whole life insurance. They should explain growth and loan mechanics clearly. Also check their credentials and references. Ask how many clients they've helped with infinite banking system. You can start small with whole life insurance. Begin with a policy that fits your budget. Pay more than the minimum premium to build cash value faster. This accelerates the personal banking systems. Structure your policy for maximum cash value growth by choosing companies with strong dividend history. C. Building a robust infinite banking system takes time. Policies also differ, so ask your advisor for estimates based on your premium levels. But remember, your protection starts immediately. Your family gets life insurance coverage from day one. Your cash value grows tax-free while you learn the system. The warning signs I've shown you appears before every major financial crisis. The question is whether you will recognize them in time. Financial collapse follows predictable patterns every time. The 1973 oil crisis, the 2000 dot-com bubble, 2008 crash, and COVID-19 pandemic all caught families off guard. But financial protection also follows patterns. Whole life insurance and infinite banking provide security, growth, and access to cash when others don't have anything. Always remember the 4 warning signs we've talked about today: overleveraging, lack of diversification, insurance gaps, and no emergency liquidity. You should also check your debt level and take action before the next economic downturn hits. You should know this by now. Your family's financial future depends on the decision you make right now. Let me know in the comments which warning signs surprise you most. If this helps you understand how to protect your family's wealth, please like this video and subscribe for more financial strategies that actually works. Thanks for watching.